Welcome to the Keiser Report. I'm Max Keiser. The greatest stock market speculator in American history, Jesse Livermore, once said, "There's nothing new on Wall Street or in stock speculation. What has happened in the past will happen again and again and again. This is because human nature does not change, and it is human emotion solidly built into human nature that always gets in the way of human intelligence. Of this I am sure. Greed, euphoria, fear, panic, market crash. Fear, euphoria, greed, panic, market crash." And as we're all stock market speculators now, we're all surely gonna die poor. It sounds like a Tupac Shakur song. Y'all?
Well, Max, of course, what has changed since the 1920s and 30s when Jesse Livermore was operating and before he killed himself in a hotel in New York City is that human intelligence has gone down thanks to various smart tablets and smartphones, ironically named smartphones. And, of course, we've invented new ways to scare ourselves, to cause even more panic, heightened panic.
Well, the cycle of euphoria, fear, pain, crash, the cycle of markets that tied into the human emotional cycle and the group psychology that happens, the herd mentality at tops and the herd mentality at bottoms, the greed and the fear cycles, these are still very much with us. And the only thing we've had different in the last 20 or 30 years is the financial engineering products that have made the bubbles extend to even greater bubblicious levels of insanity, that thanks to financial engineering. But there's been no engineering of the human mind. There's still social implications involved in market direction. You know, markets are not tied to fundamentals really in any way, particularly now that we're off the gold standard since 1971. We're completely in a global fiat money standard. There's no fundamental value for stocks and bonds. It's all based on the price that's generated through mass social interaction, not through any fundamental analysis. Fundamental analysis is superfluous.
And, well, we've had the financial engineering, but we also have high-frequency trading, which it's a true market panic can happen when they all the algorithms controlling 70–80% of all market trading, by the way, all instantly at the same fraction of the same nanosecond, the same millisecond, say sell. So that's another thing that is new. Now the VIX has increased by 35% in October alone. So that's the volatility index. People are starting to get nervous. You see the field of sheep or any other creature when they start suddenly moving a little bit and then they all run in the same direction. Well, you're starting to see that. And the new danger added to this mix of panic is leveraged money spurs sell-off as record treasuries trade. When markets are buckling and volatility is signaling a crisis, you sell what you can, not what you want. So the markets where they said scared of possibly Ebola, possibly Ukraine, possibly Middle East, something triggered the response, and people sold not the most toxic, worst stuff, but the best stuff. And you commented on that, of course, in 2008 when gold sold off. Gold sold off then because that was the most liquid.
Yeah, well, you know, John Steinbeck's Grapes of Wrath comes to mind because in that story, it was both a financial panic and an environmental catastrophe, the Dust Bowl, combining to create the worst depression in American history. Today, we've got a liquidity crisis around the world due to climate change and global warming. You've got a climate catastrophe in the making. In California, for example, they've been in severe drought for the longest period probably since the Dust Bowl. At the same time, there's no liquidity in the financial markets. So once again, it's an environmental and a financial catastrophe happening simultaneously due to a lack of liquidity, both from precipitation, that would be irrigating the crops, or in the form of financial liquidity that would be sustaining this Ponzi scheme, this bubble that's been pumped up through financial engineering over the past 20 years. And like the Grapes of Wrath, it's a catastrophe now unfolding, and you'll have migrants. You have both climate migrants all over the world that are being forced off island nations and nations that are right just at sea level. They're now being flooding into other nations. And now you have people trying to get out of their pension schemes as the liquidity crisis in these markets hits wholesale. And they have to sell everything just to pay off their encroaching, rising margin calls.
Well, this article is not about them selling off everything because, in fact, they're not selling off everything. That's specifically what they're saying is they can't sell off everything. So in the last crash of 2007, 2008, there was $70 trillion of debt owned by investors. Now it's $100 trillion. Now a lot of this is driven by central banks have put interest rates down to 0. So pension funds need yield. So they've been pouring into corporate bonds, all sorts of exotic derivatives and bonds and various things. But those are the things that were not tested in this recent market sell-off. As I say, loath to find out what their record holdings of corporate bonds and leveraged loans were worth as liquidity thinned and markets slid, professional traders turned to stocks and treasuries to diffuse the risk. The result was a frenzy. U.S. government debt volume surged to an all-time high of $946 billion at ICAP, the world's largest interdealer broker, more than 40% above the previous record. About 11.9 billion shares changed hands on U.S. equity exchanges on October 15th, the most since the European debt crisis of 2011. So what they're saying is because these huge investments in very illiquid assets, people are panicked about what they're actually worth, is even if you're trying to be a safe investor and just investing in Johnson & Johnson or General Electric or the stalwarts of the Dow, those are the ones that people can sell easily. Gold, those are the things that are always very liquid. It doesn't matter what the market is, there's always a buyer for this. So those are the things that are being dumped.
Right. Well, they came up with, you talk about Jesse Livermore in the 30s, and he created this idea of actually the stock market speculator, the modern stock market speculator, and the rules for speculating, and things never change. And one of the things that never changes is that there's always some story on Wall Street to entice people to make stupid bets. In 1987, before the crash, they called it portfolio insurance. That, you could buy a few options or futures contracts and your portfolio would be insured, and that unraveled spectacularly in the crash. Today we have something called value at risk, VAR. This is Goldman Sachs or JP Morgan. The broker will call you up to say, your multi-$100 billion corporate bond portfolio is safe because our derivatives products are managing this risk and mitigating the risk. Well, what happens is in a crisis, as you're explaining, of liquidity, that aggregate risk is both the market on either side. There is no intermediary market-making, risk-mitigating derivative product that is going to substitute for actual liquidity in the event of a crisis. And once again, people are being caught holding the bag because they were sold a bag of worms from their local stockbroker on Wall Street in the City of London. Another trick to bamboozle the investor that the risk is being mitigated is blowing up in their face once again, and they'll blame some exogenous event like Ebola. Like, no one knew that Ebola was going to happen, and it came along and everything blew up. But of course, it was going to blow up no matter what. That last snowflake to start the avalanche down into the abyss, it doesn't matter what you call it, Ebola or whatever, it's going to happen anyway.
So talking about bamboozling investors, here's an interesting quote, and then I'm going to comment after it. So here it says, the concern is the more investors buy obscure assets, the less flexible they'll be during a market disruption. In the latest bout, they went to where the volume was while hanging on to less traded assets. The less traded assets, therefore, are at the end of the day, after the next crash, what your pension fund, what the average investor will be holding, those less traded assets. And that is how they bamboozled you. You'll have to sell your gold, your silver, your GE shares, your Johnson & Johnson shares, your utilities. You'll have to sell those to your broker, to Wall Street banker sorts, and you'll be left holding the bamboozled product. They sold you these obscure assets. Right,
and who's holding the most bamboozled products of anyone in the world? The central banks. Remember, it's the Bank of England and the Federal Reserve Bank and the ECB that agreed to take on illiquid junk securities in exchange for liquid treasury notes, treasury bills. Now that there's a liquidity crisis, they won't be able to unwind those securities like Janet Yellen or other central bankers or Danny Blanchflower will say, well, we can unwind these securities at any time we want. That's a complete and utter boulderdash, because if there's no buyers, you can't be a seller. And of course there's no buyers because they're illiquid derivatives based on mathematical formula that you cooked up in the academic classroom somewhere that have a value of hamster.
Well, even the IMF warned about this. They said that there was increased risk due to all these obscure assets. But in terms of being bamboozled and who's left holding the toxic assets, there's this next headline here, and that is FHFA said to plan steps to ease lending to riskier buyers. Fannie Mae and Freddie Mac and their regulator are nearing agreement with mortgage issuers on efforts to boost lending and ease banks' concerns that they will get stuck with bad loans when borrowers default. So here we are. 5, 6, 7 years after the last financial crisis, which was triggered allegedly by the subprime mortgage bonds in America going bad, which resulted in a huge buybacks for the banks. They had to buy back all those toxic assets that got stuck in Fannie Mae and Freddie Mac's books. So now they're saying we won't lend again unless we never have to buy these back again. If these debts go bad, as they will because people can't afford it, they will be, we don't want to buy them back. So the regulators coming up with a way that they will be permanently excluded from buyback provisions, and they're also reducing the deposit required for a Fannie Mae and Freddie Mac backed loan, and that is to 3% from 5%.
Right, and this is not a victimless crime. The way to cover all this multi-$100 trillion worth of toxic securities they're passing off as liquid securities are to issue more dollars. Now, ordinarily, when you increase the supply of dollars by hundreds of trillions of dollars worth of dollars and derivatives-related dollars, the value of the dollar would go down. But it doesn't go down because America is willing to bomb Afghanistan, bomb Iraq, cause a proxy war in Ukraine. They're willing to let Goldman Sachs destroy Greece. They're willing to do a lot of things that create a lot of victims, millions of victims, to keep the dollar price high. That is necessary now that they've created $100 trillion worth of dollar based derivatives that would have collapsed the economy 20 years ago. But no, 50 cents of every tax dollar goes to the Pentagon, and they make it clear to anyone in the world that if you sell your dollars, we're going to kill you. And that's America's foreign policy. Paul Krugman has said this, and others have said this. They've all agreed. The U.S. dollar is backed by violence. And that's why there's so much jihadis around the world. They don't want the violence and the dollar. They'd rather have something more organic to their own culture and their own economy. But the U.S. is going to double down on the violence, double down on the money printing, double down on jihad-provoking financial terrorism, and no one's going to stop them. Obama's not going to stop them. Janet Yellen's not going to stop them. Only we can stop them. Only you can stop them. But we got to stop right now. We got to go. So, Stacey, thanks so much.
Don't panic, end the show so fast. It's like a collapse ending of the show, of this episode.
No, we got to go. But as a matter of fact, we're going to continue into the second half with a guest. So don't go away. Welcome back to the Keiser Report. Time now to turn to Mitch Firestein, author of Planet Ponzi, for part 2. Mitch, welcome back to the Keiser Report.
Glad to be here, Max. Thanks for having me.
All right, now, last time we ended up talking a little bit about Japan, and I want to resume talking about Japan because Japan is interesting in the annals of Planet Ponzidom. Because going back to 1989, remember, the Nikkei collapsed. It was at 40,000 on the Nikkei, and it collapsed down to, I think, 8,000 or so. And at that time, the yen, because there's a huge savings pot in Japan, you know, the famous Mrs. Watanabe, who's been saving 40% of their after-tax income for decades. They're the most scrupulous savers in the history, you know, really. And that became what's known in the trade as a funding currency, the Japanese yen. The interest rate on the yen is very cheap. It was, at that time, 1% or less, on its way down to 0.0001%. And so speculators, and you're in the business of managing money, and you're on the front line of finance, and you actually invented a lot of instruments that are used in the money market trade, money management trade. You could borrow Japanese yen at the cheapest rate of any currency in the world, and then use that cash to fund let's say, an investment in a higher yielding currency or a higher yielding bond or some kind of arbitrage play. So just walk us through a little bit about how, my question is, the Japanese market, the Japanese yen, is really the foundation of the global Ponzi scheme in many ways. And have we reached a point at this juncture where the Japanese markets got us into this pyramid scam, Ponzi scam? It looks like it could be the point of most vulnerability and could take us out into a really vicious downward deleveraging.
Well, as I said once before, that there would be an exogenous shock that could be caused by Japan. As you may recall, or for the people who read my book, I was in Japan actually in 1987 at the peak, at bubble peak. as we saw by the Nikkei hitting, I think, 42,000. So, you know, everything went down. Like, property prices have dropped 90% from the peak, and they've stayed there, and they've never come back.
A quick insert here. You believe that London could experience a similar drop in the London real estate bubble of 90% as well, right?
It will. No, I don't believe.
You think it definitely?
It will definitely happen here. I can't put a timeline on it.
Okay, continue. Just.
But you know, because it's everything's over leveraged, and we achieved peak debt in this country in probably 2006 and 2007.
But in 2007, there was I'm sorry, in 1990 in London, there was I believe a 35 to 40% move down in over leveraged property. So that was a pretty devastating retrenchment of value. You think it could be double that?
You ain't seen nothing yet. But going back to the Japan story, you know, they did currency arbitrage, and currency arbitrage is as old as sticks and stones. So in the late 80s, there was a great play, and you know, Japanese yen was a lot weaker. I saw it fall from, you know, what, 175 down to a low of 77, which we saw, I don't know, about a year and a half ago. And since then, we've seen the yen drop in value by about 25%. So it's now trading well above 100. And similarly, we've seen an increase in the stock market because the largest holder of ETFs, exchange traded funds, now is the Japanese government. So they've got an axe to grind. As you know, the other day, we saw prices go up in Japan 3.7% or over 500 points. So there were concerted buyers because they said the government and the pension funds are going to come in and support this market. So we're back above 15,000. So we'll see how long that intervention can last.
Well, the intervention by the government to buy its own debt, you know, monetizing its own debt, to keep the economy from sinking into even greater depressing levels of deflation. You know, they're trying to stop this truck, you know, that's fallen off a cliff, you know, from hitting the bottom of the cliff. And that's been cushioned for a while because of this enormous Japanese savings pool of savings, domestic savings. The government's using domestic savings. They're not going out in the foreign markets, the wholesale markets, to sell Japanese government debt. They're self-financing domestically. But my understanding, and you know, let me know what the status is, that they've basically run through all that domestic savings. They don't have any more domestic savings. So now they're out there actually in the foreign exchange markets looking to roll over their debt. And so this is where things get dicey, right?
Well, yeah, I think, you know, you reach a point, and I don't know when we're going to reach that point, when the manipulations don't work anymore. Because what we're seeing is pretty much smoke and mirrors. The Japanese economy has not turned around in 20 years. That's why prices remain down 80% or 90% from its peak in 1987. So if you look at stocks in terms of, well, the Nikkei was at 42,000 at its peak back in the late 80s. Now it's only at 15. It's a real bargain, right? And you look at every other global stock market around the world, and we're seeing all-time highs when we're seeing global growth slower than it's ever been. So there's a fundamental disconnect. Now, the correction that we've seen in the United States, we've got another chart of the U.S. Dow. I mean, you see that the Dow has gone down, which proves you can never taper a Ponzi scheme. My famous quote that we'll have put somewhere one day, that the Dow has gone down, but it's only gone down 8% from its peak. So there's still a long way for it to go. Now, we're in a period this month of blackout where the corporations can't buy their stocks back because they're coming out with earnings. Between now and the end of this month, they're prohibited. And that was one of the biggest buyers.
Oh, okay.
Okay, so the stock buybacks were all the companies buying many shares because the CEOs and insider selling evidently has been the highest it's ever been.
All right, so every quarter there's a period where there's a blackout period. Corporations can't buy back their own stock as they lead up to their earnings reports?
Correct, because then it would seem like they were manipulating the prices. And we know no markets are rigged, right, Max?
Right, well, I know that that's interesting that, well, the point is that the corporations have been buying back their own stock at record amounts. So they borrow money from the Fed, or the funding currency in this respect. I mean, you can borrow money in Japan essentially for 0%, really 0%, and you can buy back your own stock. And then you goose the earnings up because there's less stock out there in the outstanding world.
Yeah, that's correct. But what they're doing also is their record amounts of corporate debt that they're issuing, which is, this is the liquidity trap that we've got ourselves into because people like Paul Krugman, have said there's not enough debt out there. So now let's just recap. What caused the problems in 2007 and 8? Too much debt, too much credit, and too much leverage. Leverage loans are at a peak, higher than they ever were. There's more leverage out in the system, and all that it's done is created a toxic bubble bigger than we've ever seen. So
okay, but talk about this toxic bubble for a second, because here you have the FHFA. They're nearing an agreement with the banks to ease lending to risky borrowers. So the problem back in 2008 was subprime mortgages. They had risky borrowers allowed to borrow in a risky way that blew up.
Yeah, but that was.
But now the FHFA is they want to ease borrowing standards again, right? So they didn't learn anything. The bubble's continuing.
Yeah. So when you go back to and you look at Fannie Mae and Freddie Mac, there was a guy named Barney Frank who was a famous legislator in America that kept getting reelected in Massachusetts because they're extremely. They just vote Democratic. They go in and hit Democrat, Democrat. He actually came out in the New York Times and said that the Republicans are making up the fact that there's over leverage. Fannie and Freddie are fine institutions. They're solvent. They should lend money to everybody. They should increase their lending. And he got reelected. Now, I'm not Republican or Democrat, right? I vote my conscience and I vote the right thing. If I was in office, I would go out and actually tell people the truth, which would be refreshing. You might not want to hear the truth, but you've got to talk about aggregate debt levels. Nobody wants to talk about debt. Back then, it was like just extend and pretend. The 4 Ds: divert, deflect, deny, and deceive. And we're back where we were.
Yeah, but
except it's bigger this time. That's it. It's a Ponzi scheme, and no Ponzi scheme ends well. It's like, I don't know what they're expecting. Do they expect President Obama to come in riding a unicorn with rainbows in the background?
Right. No, the timing is the question. We know that it's going to blow up. We're just not sure about exactly what the timing is going to be and what the exogenous event that they'll blame as having never anticipated that suddenly dried up liquidity in the markets, and we have this enormous event. The key here, as I see it, is that there is no liquidity in these markets, and so they're completely fragile to an exogenous event which comes along, and there's no bid. So people just sell at any price, and there's a crash. There's no reason why these markets should be without any liquidity. The reason they have no liquidity is because there's no savings. Why there's no savings? Because there's nobody making any money. There's no wages. Because there's nobody who has any right to lobby for higher wages. Those people have all been taken out of the equation. All the unions have been busted. All the collective bargaining has been ruined. All of the indexing of wages to inflation is moronic because they say there's no inflation, even though it's running in real terms to 10, 11, 12%. Why shouldn't people who work on a wage lobby to have their wages not tied to the fake inflation index numbers, but tied to money supply numbers? Say, if you're going to do a quantitative easing and increase the money supply by 20%, then you've got to increase our wages by 20%. Otherwise, it's financial repression.
That's exactly correct. But what's happened here, if you look at it, people will not be able to hire labor in London anymore because of the exponential increase in house prices. So there's a fundamental disconnect here because wages haven't gone up. It's pathetic that I saw somewhere that apprentices get paid like £2.70 an hour, okay? And the minimum wage is £6.50, I think, here. So if you figure out what a tube ticket costs to go back and forth, you can only pay your tube ticket. So you can't pay for your rent and you can't pay for your food. So, you create a bubble and then you create a vacuum and all the labor gets sucked out and then it explodes. Now you had this week Barroso, who is from Portugal, coming in and dictating.
Running the EU.
Yeah, running the EU. He was
Brussels.
the president, non-elected president. So he was self-appointed. He put a little crown on his head and came into the UK and said, you listen, immigration caps are illegal. You can't do it. You are under our rule now. And he told David Cameron while he was speaking at Chatham House, you can't get away with that. So let's look at it. The Portuguese economy, where he came from, is less than 1/3 of 1% of global GDP, right? So I think that they make about 110 billion euros in GDP. So it's a tiny little country. And he's running the EU, which is one of the biggest economies in the world. So should the UK leave the EU? You bet. Otherwise, they're going to get saddled with all the debt from the next round of bank bailouts.
All right, well, this is we got about 40 seconds. Let me just jump in and ask a final question here about the government here in the UK is touting wages and jobs, and yet tax revenues are down. isn't it true that they don't really need tax revenues because they can just print money? You know what I'm saying? Like,
yeah, well, they can print all the money that they want. But
so they don't need
as
tax
I said,
revenues.
what
so
they're
they don't
going
care.
to do, taxes are going to go up a lot. But the problem is the job creation has been substandard, and it's been low pay, very low pay, part-time, 0-hour contracts.
And it's obvious that there's no tax revenue.
Because there's a 2015 election, and they don't care what they tell you as long as they get elected. So there's going to be a big earthquake with the next round of elections.
All right, we got to cut her off there. Big earthquake coming in the next round of elections. Mitch Firestein, thanks so much for being on the Keiser Report.
Thanks for having me here, as always.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Mitch Firestein of PlanetPonzi.com. If you'd like to get in touch, tweet us at Keiser Report. Until next time, bye, y'all.